Hello, my name is Ryan Hogan. I'm the large cap portfolio manager at the Oregon State Investment Group. It is week 1 of fall term for 2022 and our current value is $3.19 million. Our 1-year performance here, as you can see, over the summer we had kind of a volatile summer. If you look at the chart, this goes back 1 calendar year. We don't have that much alpha for 1 year, and our year-to-date returns are down. This is a direct cause of the Fed raising interest rates, which I'll go into here in a minute. But you can see our weekly return here. We generated some positive alpha versus the S&P, so we're looking to climb back here. Our 1-year beta is 0.94. Our year-to-date beta is 0.88, so we're staying below 1, which is good. Unfortunately, it's not reflected, or our performance is not reflected that greatly in our 1-year Sharpe ratio, which is a risk-adjusted return ratio. When you compare it to the S&P at negative 0.54, we have negative 0.94, so we're being undercompensated for risk that we're taking in the market, which is not a great sign. Since we've started the fund back in 2007, we've returned to 219% versus the S&P of 218.87. So we're still beating the S&P over the long term, but again, it's still pretty close. It's within our margin of error, so it's nothing to be too excited about. Again, our plan going forward is to really outperform the S&P, and we're going to be making some portfolio changes here in the upcoming term. Going into the yield curve and economic data, the inversion is still present. If you look at this chart, it basically shows you the maturities of all the government bonds that you can buy in the market. The orange line represents what they yield today versus last month, and then the green line is a change, or the delta in between the two. As you can see, the maturities from the 2-year through the 5-year saw the highest change. So they rose the most month over month. And here, my kind of idea is the market seems to be pricing in short-term inflation and discounting the 2 to 7-year previous inflation expectations. Inflation year over year is 8.5% versus 8.3% in June, which is not great. So as we're seeing the Fed raise, it's totally justified. They're trying to curtail inflation. My personal opinion is it's more of a supply side issue than a demand side issue. And so as we see kind of the supply chains move and get back up to speed, we should expect inflation to come down significantly regardless of if the Fed raises or not. If they raise too much, we risk going into a recession. But again, we have never seen the Fed raise this aggressively since pretty much the 1980s when Paul Volcker was the Fed chair. So in June, we had an FOMC meeting, a rate hike of 75 basis points. Fed raised the Fed funds rate to 1.65%. Again, you get the current Fed funds rate to give you a reference. This is the end of the second quarter for the economy. And this is basically a chart of the S&P for the month of June. We were down 7.7% as the S&P was. NASDAQ returned worse because it's overexposed to technology, and as you get these these companies in the tech sector that are basically a big bet on future growth, they're pushing their cash flows, they're pushing their profitability out into the future. You don't get that kind of that stability that you see in some of the more staples of the economy, industrials, materials, consumer staples, companies that are making cash and making earnings right now. So those tech companies that are pushing out their future performance, they're not going to perform as well, and this is exactly what we saw. The 20-year yield or government bond yield index returned negative 1.16%. I found this interesting because historically bond prices and stock market prices have been inversely correlated, but now in the last year, 2022, we've basically seen them become correlated, and correlated in the down direction. So everything's basically selling off, getting devalued. Again, we've never seen the Fed move this aggressively to curtail inflation, so it's going to be a bumpy ride going forward. But again, we'll see. The USO oil index returned negative 6.01%. This is basically an index that's made up of oil futures, and so we really saw oil come down in the price of June, which is great. Again, the Biden administration is not giving out any tax breaks or incentivizing any oil companies to drill more or build more refineries, which is going to put upward pressure on prices. But again, we'll see. Lots of buying into the general market at the June low on the 17th. So my guess is if you can look down into kind of where between the 16th and the 17th, probably the morning of the 17th, we saw a lot of institutional buying and kind of pushing back up those prices. My guess is people thought this was a bottom. We'll see. And past that date, the market rallied 3.23%, and that's where it closed for the month. So the Fed continued to unwind their balance sheet, announced May that the cap will be set at $30 billion. This month increasing to $60 billion after 3 months scheduled for August. So we'll see how that affects equity prices. We'll move on into July. So I've included a tweet by one of my favorite investors, Michael Burry. He basically is saying this is a bear market rally. We'll see. The FOMC had a meeting. They rate hiked again for 75 basis points. They raised the Fed funds rate to 2.25%. Again, you get that reference rate of 3.08 to 3.25% currently as of September. And we had our Q2 data released for the U.S. economy. This basically put us into a categorical recession. Every recession is different, and every cause of every recession is different. So my theory here is, are we in a recession? Are we not? I don't know. Technically we are by definition, but it doesn't feel like one. The consumer is still pretty strong. You look at companies' balance sheets and consumer balance sheets. Coming out of the pandemic, nobody was really out spending a whole lot of money. So it's a very strange kind of categorical recession. People still have jobs. Unemployment is very, very low right now. And they're still spending in the economy. So, I'm not sure where we're going. I don't think anybody really knows. It's all just one crazy roller coaster. But for this month, the S&P returned 7.6% over the month, and the NASDAQ returned 11.39% over the month. I found this interesting because my guess here is people thought it was, a market bottom, and the Fed would not hike that aggressively going into the future. And so we had a great month in July. The EU tweaked its sanctions to unblock Russian oil deals with third world countries. So that's great news for the consumer. Oil fell, and the rate hike and demand concerns held back price gains for oil. The index gains during July prompted fears of bear market rally or bear trap, as you can see from the tweet here. And the Fed, again, continued to unwind their balance sheet. So we're keeping a close eye on the Fed and not trying to fight the Fed. I don't think moving against the Fed is still that great. And you should always be watching what the Fed does. And the yields on the U.S. Treasuries fall slightly at the end of July after CPI comes in unchanged month over month. So this was good news. The CPI didn't move. So again, my guess here is that institutions, investors across the world kind of allowed themselves or are allowing themselves to believe that inflation has topped, and you will see a more dovish Fed rather than a bearish one. You might even see some rate cuts instead of hikes, but again, we'll see. So for the month of August, you basically had a reversal. The FOMC did not meet. Again, you had that Q2 data release that investors were digesting and picking apart. Basically, all the gains in July were erased. Oil returned negative, so you still had falling oil prices, which was good. And my guess here is the index losses were attributable to inflation fears. So you had a CPI report that came out and all the investors that were betting on inflation topping out uh, were wrong, essentially. Food and food prices were up 13.5% for the year of August, and the index for all food items, really core inflation, so that's inflation taking out volatile items such as food and energy costs, that tend to be more volatile than other staple items, saw a 6.3% year over year inflation raise. So that was not great news, and the market reacted accordingly by basically erasing all the July gains. The Fed continues to unwind their balance sheet. Yields increased across the board, and unemployment moved from 3.6 to 3.7%. Kind of anecdotal evidence, but again, my prediction is until you see kind of a decrease in companies hiring and you see some job cuts, you're still going to be dealing with this inflation issue. People have jobs, people have money, they're going to be spending. They don't care, at least right now, if their 401k is not doing the best. They have jobs, they're out and about, they want to travel, they want to go out to eat, they want to buy new things. They've been cooped up for a year and a half from the pandemic, and their balance sheets are strong, they have a lot of cash, and they're not afraid to throw it around a little bit. Portfolio update, I've included a correlation chart here for all of our holdings. So we have 28 holdings here at OSIG plus cash. And so post-summer, our correlations are our portfolio against every holding in our portfolio. So if you look at the X and Y axis, it's basically a copy of itself. And as you can see, as you move up and down, you can see each holding correlated with every other holding. And if you correlate something with itself, you get a perfect correlation because it's the same, so it's a 1. But if you correlate it with, Domino's Pizza in our portfolio versus Adobe, it has a negative correlation. So some days when Domino's Pizza moves up, Adobe will move down, and vice versa. When you look at, efficient portfolios that tend to weather storms well, weather recessions well, you want some, negative correlations in your portfolio to protect you from, downside or upside movements that you're not hedged for. And so we're a long only U.S. Equities portfolio of market caps of about 8 to 10 billion or greater. We mainly just deal with blue chip stocks. And we have a team of analysts or student analysts that come in through our group and pitch different companies. They do full discounted cash flow. They use a bunch of different models that I'll go into in a later video. But basically, they do research on these companies and then issue a buy, sell, or hold recommendation, and based on the group's vote, it gets incorporated into our portfolio or sold out of our portfolio if we find certain risks that we don't want in our portfolio. So we have multiple positions that are negatively correlated, but again, we want to see a little bit more red in this chart just to protect us from kind of the intra-week volatilities. The 20-year TLT index, or 20-year Treasury, ticker symbol TLT, has historically been negative correlated to stocks. Again, I talked about this a few minutes ago. But again, you're kind of seeing as the Fed hikes interest rates, everything's moving in the downward direction, which is not great. So the real uncertainty doesn't lie with equities, it lies within the Fed. Will they raise again? How far will they go? Will we see the Fed funds rate move from 2.25% all the way up to 6%? Nobody knows. And the Fed only meets ever so often. And so when they do meet, they're deciding on basically making a decision on whether to raise the Fed funds rate. They're a lender of last resorts, and this Fed funds rate affects all other rates for borrowing and opportunity costs in the market. And if you look at a lot of the common financial ratios that investors use, it really comes down to cost of capital for companies, opportunity cost for their money. And historically, moving from, coming out of the recession in 2008, we had historically low Fed funds rate. So the opportunity cost was not really great for investors. It was, do you want to earn, a couple pennies on for every dollar, um, versus investing in, a tech company that you had kind of this tech run up. If you look at the NASDAQ, from, coming out of the recession in '08, it's just been exploding. So dividends and other metrics, we had over the summer $25,724 in dividends since June 15th, and then 28 holdings plus cash, which I talked about a little bit. Here's all of our holdings, and I'll probably do another video going through each of our holdings and why we believe they're quality. And as of now, we have $92,159.74 cash as of this morning, and we'll be adding to our positions through October. Again, with every kind of downturn in equity prices, we get excited because it means we can buy, the companies that we've vetted as quality. We can buy more of their stock, which is great news for us because we here at OSIG, we don't really have an exit per se. It's just the university foundation's money, and it's gonna be held in perpetuity. So we don't need profits now. We don't need cash now. We're not selling anything to use the cash to consume. It's really just long only and long into perpetuity. So market sentiment going into where we are now, you can see the fear and greed index. What I've shown you, the VIX, or what I have up here is the VIX. It's up 91.2% this year at 3176. This is historically high. The VIX is basically a 30-day anticipation index for options on equities. Basically, it's measuring premiums in the market. And I'll go into the equation for that in a later video. The S&P is down as of today, 24.57%. We're at the lowest low. You can see the fear and greed index over time. It's extremely fearful right now. And the dollar index is absolutely exploding. So my fear is, as the dollar moves up in value, all the other currencies are decreasing in value. And so some of the tech companies that do business overseas, or really any company that does business overseas, especially service companies that, do these deals where, they provide a service or products and they don't expect payment for 30, 60, 90 days, even a year out. If this dollar index moves against those companies, they're going to take massive losses on their business dealings, and it could, accelerate kind of their losses, not only in their stock but on their, cash flow statement. Because as they do these deals, if they do a transaction and then they expect payment in 30 days, if the dollar index moves up, when they go to get paid in that foreign currency and they go to exchange for dollars, they're taking a loss because the dollar index has already moved against them. So when they go to exchange, Japanese yen or really any other currency, if the dollar index is up, they're basically losing value. And I'll go into that in a little bit more detail. I'll just run down everything right now. Markets are still over volatile on the way down and under volatile on the way up. This is historically true. Everything is still macro, top down versus bottom up investing. So top down is looking at interest rates, just kind of macro factors, especially the war in Ukraine and Russia. Food prices. So no one really cares if you're signing up subscribers or how you treat your customers. It's really, what is the Fed doing? Where is inflation at? If it's bad, your company's getting sold off. It does not matter if you're, even beating earnings. And I think that this upcoming earnings season will be a perfect example of that. You'll have companies that will beat and then get sold off because it's still top down. I could be wrong, but we'll see. 40% of the world's potash or fertilizer comes from Russia and Belarus. This is putting really, really big upward pressure on costs. Canada still remains the largest producer for fertilizer, but it's not going to cut it, or it's not going to make up for this 40% distribution from Russia and Belarus. So as you can see, the Fed funds rate from 1980 through today. This is basically a chart of when they hiked interest rates and they curtailed inflation but led to a recession in '82. As you can see over here, the gray bars indicate recessions. Moving on from here, you had an explosive stock market just in the upward direction, which was really, really awesome for equity holders. Again, you had that Black Tuesday crash of '87, but um, falling interest rate environments tend to produce an outperforming stock market when you look at the mean performance over the 30 years, and then rising rate markets tend to kind of curtail that growth as everything gets revalued from the top down. But as you can see, the explosive growth also after we had the '08 recession, Fed funds rate was minimal. And you have some buildup, and then the coronavirus where it cut back down, and then you have that buildup again. So expect some underperformance just overall in the stock market going forward. I still think it's good to be long U.S. equities if you are going to be long anything. U.S. equities are really the safe haven asset, and you can even see that with the dollar index. America is where investors want to keep their money. And so low rates allowed businesses and ventures, especially after 2008, to find cheap and readily available capital, while globalization helped bring down the cost of goods and services as onshore business could outsource to developing countries, for example, China. If you can make it cheaper over in China, you can sell it for pretty inexpensive over here, which contributes, as CPI is measured, contributes to kind of a lower inflation environment for that. Here's a 1 year performance of the S&P 500. As you can see, investors fled from some of the big tech companies and focused their investments in healthcare and energy. Energy has historically underperformed the market, so it's great to see them come back. And you look at the losses in communication services and financial services. It's not a great bellwether for what's to come. So be cautious and stay hedged in the market if you're a fund or you are a sophisticated investor enough to do that, and always be watching what the Fed does for this next couple months or even a few years. Thank you.